Welcome back for another episode of Strive for 25. Joel Farrell here, and looking forward to sharing with you our guest today.
Welcome back to another episode of the Strive for 25 podcast. I've got an amazing guest today, Marc Oshiro, who is over the ocean in Hawaii, and he's here today to share his story. And this fits into a couple of our categories in terms of the savings equation and the investment equation. He's a full-time firefighter, also a realtor, also an investor, and just really excited to dig into his story and some of the lessons that he's been able to learn and also share with people in his community, because he's also on social media sharing his story. So Marc, give our listeners a hello and a little bit of background on you real quick.
Well, thanks for having me on. I'm glad to be here. So I'm a full-time firefighter, like Joel said. Just got my real estate license in 2022, and I'm an out-of-state investor. Just realized that the numbers don't make sense a lot of times in Honolulu, Hawaii. Nothing really cash flows here, and started my journey 2021 and kind of went all in, and now have 14 single family homes in Pittsburgh.
All right. That's kind of where I think we should start is you go from, no properties other than the ones you had in Hawaii. And then in 2021, now we're in 2023, the beginning. So in a couple of years, scaled from 0 to 14 in a different state. And that's definitely unique. And, definitely there's more and more people that are, purchasing property across state lines. Now, we see a lot of that on the institutional side, the bigger company side. But for an individual investor to do that, it's really, really cool to see. And, the outline of your business, you started in 21. So what was the very, very first property that you purchased? And then we'll dig into the last one and then kind of go in between.
So you mean purchase as an investor?
As an investor in Pittsburgh. Yeah, let's talk about that first one.
Okay, so I started actually looking into this maybe 2020 when the pandemic, everything was shut down. Me and my son's mom were on rocky ground, and we split up during that time. And one of my good friends was investing out of state in Pittsburgh, and he'd always be telling me, that I should look into investing in real estate out of state. So, I had a lot of time on my hands now. I had equity in my home. So I decided to look into it further. And the one thing I want to say is, like, Pittsburgh, I wouldn't say it's probably the greatest market. I mean, there's a lot of great markets out there, but to me, it was having boots on the ground, and my friend, he had a team in place, and he went through a lot of troubles. He made a lot of mistakes in his beginning of his journey. So I decided that Pittsburgh's a good place. He had a team in place, and I started looking at properties. I would do a lot of things different now if I was to start over, but definitely, you kind of go in it with a game plan of particular types of properties that you're looking at. So, I mean, at the time, I would say my buy box was a little bit more broad. I mean, if I was to do it over, it'd probably be a little bit more narrow now. But at that time, you're kind of you're looking at maybe 2 to 3 bedrooms, 1 bath. My friend actually, what got him into trouble in the beginning was he saw like very cheap houses and was just attracted to the cash flow. So he was buying $30,000 to $40,000 properties, and he was cash flowing well, but he was having a lot of tenant issues and whatnot. So when I started looking into it, I said, at first I saw these very cheap houses, and I was super excited. But then as I started talking to the realtor and property managers and the insurance people, they definitely were talking about how they wouldn't feel comfortable walking in those neighborhoods at night. So it kind of changed my game plan and my focus into a different price point. And definitely I want to stay under the median price. And then, my first property was a basic 3 bedroom, 1 bath. Uh, I did the whole cash offer initially. I had a lot of equity in my home, so I had a HELOC. My plan was to do all cash, be a little more attractive. The market was, kind of hot at that time, so I wanted my offer to stand out. So did the all cash offer, and my plan was to, wait till the season and then do a refinance and pull out the cash and continue on. And I learned a lot of things through that process also. But that was my first property. I want to say it
So
was.
yeah, I was gonna say, so on that first property, what point of 2021 was that? What month was that? Or
This
ballpark?
was probably about in March, somewhere in the beginning of 2021. Yeah.
Okay, so March. And that first property, what was the price range?
I want to say it was about 125.
Okay, so 125.
Yeah.
And that first property, was it pretty much turnkey, or was there any type of work that needed to get done?
I would say it was rent ready. So, if I wanted to, tenant could probably move in. Yeah, it wasn't. There would probably be some little minor issues if I really wanted to paint it and if I really wanted to do certain things to get it maybe top dollar. But it was rent ready where, basically the tenant could move in right away. So there was some minor things, but that was pretty much, taken in the closing, for sellers concessions or sellers credits. But yeah, so it wasn't like a flip or a lot of rehab needed to be done.
Cool. Sorry. So
No,
from a payment standpoint, and then also the initial rent from the property, what were some of those numbers off the top of your head, if you remember?
so it did meet that 1% rule. I mean, so it was roughly where the rent was 1% of the purchase price, basically. So it was I want to say it was 1350 was my rent at that time, and it has gone up. So I have renewed it. So people talking about rents going down and whatnot, but so far my rents have still been going up. But so it was 1350. It was, like I said, it was all cash initially. So definitely my return was a lot greater in the beginning until I was going to do the refinance. But then I also, during that process, I learned about, if you do an all cash purchase, you can also do a delayed purchase refinance, and you don't have to wait that 6 months, and you can start the process to pull out your cash quicker. So that was something I learned in the beginning too. And also one thing I learned too is about the whole transfer title fees. That's something definitely new investors want to look into is whatever market they're going to be in, definitely know like the taxes and the transfer fees, because every market is different. And of all the places I invested in, Pennsylvania probably has one of the highest transfer title fees out there. And so what I also want to do, start putting them in LLCs. So just from transferring it from my name into an LLC, it costs about $5,000 to $7,000 just to do the transfer. So
Holy,
it is
that's more than
costly.
I
Yeah,
thought.
yeah, it's pricey. But
So that first that well, so I think that you said that you were gonna do the delayed financing and pull the cash out, because that loan would have been in your personal name at that point in time. You would have done a regular conventional loan, not a commercial loan.
so that so that first one did go into an LLC, but as I was closing that first one, I started a second purchase, but that was going to be traditional financing. Yeah. So as I was closing on one, I was in the process of getting a second one, but that was with regular financing in my name.
Okay. Okay. So, but the first one, did you ever end up finishing that refinance to pull, kept the cash out?
Yes, yes.
Okay. So that loan, did you do it in your personal name or did you do it in an LLC?
It was in an LLC. Yeah.
Okay. Okay. So that LLC loan, did you work with a commercial company or did you work with a regular mortgage, residential mortgage company on that?
Yeah, with a kind of,
Hmm.
I guess, private lender or
Okay.
commercial lender. Yeah.
Okay. Cool. So I just think it's really, important, as we're talking about this, you got to that point of being able to have the equity in your house to be able to pull out and then be able to make a move in a different market. So obviously the Hawaii housing market is very different than a lot of markets in the United States. Now there are some others in certain areas that are high cost areas like LA and DC market and a few others. But right here, right now, what would you say the average home price is in the Hawaii market as a whole?
So the single family home median for December just came in at 1.05 million for single family homes, and
Okay.
condos finished up the year at 500,000.
Wow.
Yeah. So it's crazy.
And how long ago did you purchase? So the house that you ended up doing the equity loan initially, because I think you already sold that house or going to sell it. That house you pulled the equity out. What year did you purchase that home in, initially?
My primary was in 2015, but then I had a condo that I purchased in 2008.
Oh, okay. Okay. So which did you do both of them, or which one did you pull the equity out of?
So at first, the first HELOC was on my condo that I was renting out.
Cool. So, and the reason why I asked that question is that, some of the listeners that are out there, maybe a millennial, Gen Z, and this is something that I had to learn is that just time, like me personally, I'm guilty of this. I want something tomorrow. I want it the next week. And, in my own real estate journey, I didn't get time that, hey, other opportunities could open up just by purely waiting, letting time work for you in terms of appreciation and mortgage pay down. And, for your situation, it was the kind of the gateway into another opportunity in a different market. So I just think it's interesting as, more information is shared out there in social media and et cetera. There's more and more people that are able to do things across state lines. So that first property, the second property. So in 2021, how many properties did you acquire? Putting you on the spot here.
I acquired, I guess, 10 technically. The other four kind of wrapped into the beginning of 2022. So they didn't close at the end of each. So there was about four that wrapped into the beginning of 2022.
Cool. So from my standpoint, when I put on my mortgage hat, we have limitations of what somebody's able to do to be able to get to the next property. So let's say you buy, an investment property, you're going to put money down, you're going to have a payment that's in if someone does a residential loan, that payment's going to be in their profile. And, the rule of thumb in mortgage is that you want to have 2 years tax returns to be able to show the rental income. On conventional loan, there are ways we can use leases to offset the payment. And once you get a couple in your profile, especially if you do it fast, if you're doing residential lending, sometimes there can be a limit to what you can be able to kind of fit into your income profile, even if you have the cash. So I heard you say kind of private lender, private money in there. And so, that kind of stair-stepping stepstone up from the 2 to 3 to 4. Are you able to share a little bit about how you're able to acquire those and what type of debt structure that you did?
Yeah, I mean, so that, like I said, I did all cash first. I want to say there was the all cash one, then there was two that were going to be, or two that started in my name. So the next two purchases were in my name. And I just started looking at it like, how do these other people, other investors have 30 rentals or 50 rent? Like, how do they scale? Because I'm only at 2, and my debt to income was already at where a traditional lender is not going to lend to me anymore. I'm not going to get conventional financing. So I went down the rabbit hole and I started researching and looking up, financing and whatnot. And I came across like non-QM lenders that do debt service coverage ratio, which is basically asset-based lending. It's based off of the property, and that just opened up things for me to scale. Definitely, something that I really learned is that interest rates, yes, they matter, but they're only one number on a spreadsheet, and so much people get caught up with the interest rate number that they're getting. Where you go with the non-QM lenders or these asset-based lenders, you're always going to pay slightly or have a slightly higher interest rate than conventional financing, but it allows you to scale. And that's what I realized is that I got, in the beginning, you kind of like, oh, I want the lowest interest rate, I want the lowest payment and whatnot. But your payment matters, but if you're making 20% return on your money, and you're paying an 8% interest rate, you're still making a good spread there. And that's what I realized was it's not just the interest rate that matters. For me, it was the ability to scale, and the commercial lending or the non-QM lenders is what allowed me to scale. So that's why a lot of times it's no tax documents, no income, no W-2s. It's basically your credit score, proof of funds, and the lender's gonna base it off of the assets. So as long as the rent meets a certain requirement above the payment, then you're pretty much good to go.
I love it. I mean, then that becomes duplicatable. As long as you have the funds, then it becomes duplicatable, right?
Yeah, yes. I mean, that's to me something else too, is you want simple and repeatable steps. And I it's good to search for different lenders and always look for different rates and different products. But what I found out is, when you find a good lender that you've worked with, it definitely makes the process a lot easier and repeatable. And the lender knows you. They know your time. Time zones are a factor here. There's being in different time zones. They know kind of your financial background, financial history. So definitely working with one lender makes the process a lot smoother also.
So you mentioned you threw out the interest rate of 8% as just an example. And so going back in time into 2021, we were in a different, universe. we were in the Andromeda galaxy in terms of rates compared to where we are today. So kidding aside, I mean, your rates were in the 2s, 3s or whatnot. And so an investor type of loan probably would have been in the 5s, maybe 4s or 5s. So am I in the ballpark if I said maybe the difference in rate could be maybe 3% versus a residential loan versus your DSCR investor loan, somewhere in that range?
Yeah, I mean, I would say definitely 2 to 3. There's definitely a lot more options now. There's interest only, 10-year interest only. There's different programs out there, and that's why it is good to search for different lenders and then see what they do offer. So for me, all of mine, I luckily got them all under 5, which was high at the time for me. Like you're saying, for other people that are getting in the 2s and the 3s, and an investor, I got it under 5. But if I look at it now, I'm like, I'm winning, right? I mean, considering what the rates are now, even for primary residence. So yeah, all of mine are under 5.
So even on the non-traditional non-QM loans, you're in under 6 back in those days.
Yes. Yeah. Oh, yeah.
That's awesome, because those rates today are in the 8s and 9s and 10s, depending on all the details.
Yes.
But the reason why I wanted to kind of dig into that is because the psychology of an investor and how they're analyzing deals, and then the tools to make it happen. Because the financing, all it is a tool to acquire the property. So in that example that you mentioned before, of the 125 was the first property. So I just did a simple example. Let's say you put 20% down, 8% versus 5%. The difference of 3% on 100,000 ends up being about $200 a month on a 30-year amortization. So just some data to think about. So let's take that actual property. So the third property that you did a non-QM loan, what was the starting cash flow before you start taking out, any of the additional expenses, but just rents versus the mortgage payment? Do you remember what that kind of ratio, what those levels were?
So the first, I want to say 2 with the non-QM lender probably was the cash flow was, I would say 500. But the thing with that, the cash flow looked greater, But because I was new working with the lender, a lot of times your initial down payment is going to be higher for maybe your first few transactions. So I want to say my first two that I had to do, I had to put 30% down, being a new investor and kind of getting seasoned with that lender. So the cash flow was greater, but that's also
Right.
because my down payment was higher. So, but yeah.
Cool. So I kind of want to go backwards in time because, one of the things that we talked about our previous conversations is that previous person that had kind of made some mistakes that you mentioned before, starting at that lower level, that lower down payment level, and then not the right tenant base or whatever. If you go backwards in time, how did that conversation even come? So this is a friend of yours, somebody you know, either indirectly or directly. How does that conversation even come up about, well, shoot, I'm investing in Pittsburgh, a million miles away?
He, like I said, my son and his son are like best buds, so we always see each other. And the one thing we always joke about in Hawaii is everyone knows everyone, or everyone, someone from back in the day. So he's actually like, we're basically the same age. So I'm sure I've met him at parties and stuff when we were younger. But his good friend also is my high school classmate, and that guy I'm stationed with at the fire department. So we all just run in the same circles. So, but he would always be talking about investing, and he's very big on the fire movement of trying to retire early and buying your time back. So he definitely was always putting it in my ear about real estate and what he was doing, and it just got me in. Like, I hate to say it, but splitting up with my son's mom probably just provided me with a lot more opportunities and time to kind of focus on what I needed to do. And luckily, I had equity and stuff available that I could use to do this. But yeah, he was putting it in my ear, and I'm just I'll look into it. And um, my uncle was in real estate a long time ago, and I guess he actually gave me the Rich Dad Poor Dad book probably 20 something years ago, and I read it, and it never related to me. And I want to say I picked it back up when my friend kept talking to me about investing, and I said, you know what, everybody talks about this book. I'm going to read it again and check it out. I read it, and it just kind of stuck with me. And I have it right here. I have this book just kind of really puts you on the path and changes your mindset, and it's just makes you see things a lot different.
Yeah, I have, my personally kind of in the same sense of reading a book hits you one way, and then life experience happens, things change in the world around you, and you get into it again, and it has a different impact. And I think that's one of the things that's so interesting about my own journey of having this podcast and talking to really, really interesting individuals like yourself that are doing things and making things happen. And also, just as a side note, you know, uh, Mark and I connected on Instagram because I was following his story, and I just kept following and following, and loving the message and loving the inspirational stuff. And on Instagram, you're going to find him at Financial Firefighter with a couple underscores in there. So financial underscore fire with dots in there underscore
Yeah,
fighter.
I think if you just look up financial fire, it'll come up. Yeah.
Yeah. So we're talking again about, Rich Dad, Poor Dad. You read it one time and life happens, and, you get into it again, and, it hits you differently. And the people that I've had on this podcast, almost every single one of them has had some type of pain event or some type of event that's shifted their mindset on things and is pointing them into a different trajectory. And, pain, struggle, failure, some people try to avoid that, but at the same time, some of the best lean into that failure and use it as fuel to get out of their comfort zone. And so that's one of the things I love about the story is that, you never want to see somebody go through pain and struggle and having relationships be affected in certain ways potentially. But at the same time, reading a book once and never coming back to it and never learning from it again, never actually implementing anything from the book, that's just wasted time. But over and over and over, your subconscious starts to take control. It leads you down a different path, opens your brain up to new opportunities, and also what you may be able to believe in yourself. And the reason why I bring that up is because I know Mark, with his social media and some of the people that are around him, he's taking time out of his, day and week and whatever to be able to try to, impact people around him and show some other the younger people around him that, hey, there are ways to be able to get ahead and build wealth, and real estate is just one tool. And some people just aren't ready to accept the message, and that's okay. It doesn't mean that we shouldn't be still providing the message. And so anything you want to share about that with some of the conversations and people around you that you've been talking to about this stuff?
Wow, it goes almost back to that. This is just being born and raised in Honolulu, Hawaii. We kind of grow up seeing real estate appreciating, and most of my parents and my friends, their parents, we're all raised to, your home is an asset. You have to get home ownership, and you pay off your mortgage as fast as you can. And so that's just what was ingrained in us. And I definitely, that was the path I was headed down. And I definitely fell for the trap of working for my pension. We have a great retirement system in the fire department, but I just saw it as, get a secure job with a great pension, great benefits, and, do your 25 years and then you're going to retire. And COVID and the shutdowns just really opened my eyes to what was out there. And unfortunately, people were losing their jobs. People were getting laid off. And fortunately, I was still able to work, being a first responder. But it made me reevaluate things, and I just looked at it like how risky I was being with my financial future of just having basically one income and relying on my pension and having to finish my career to get all these benefits. So it just made me look at things differently. And now I'm trying to help, especially a lot of the younger guys in the fire department, or even the older guys who are relying on this pension. And if you look at it like right now, inflation is at 7% right now. It was just at 9% a few months ago. But when we retire, we're on a fixed income. Our pension is great, our retirement is great, but when inflation, something like that happens, now your cost of living is going up, and you're going to have to either start cutting back on expenses or lowering your lifestyle. But being on a fixed income makes things challenging. So I started looking at it like, I'd rather figure out a way to generate passive income. And yes, if I have my pension, then great. But I also want to figure out how to generate income while I'm sleeping, basically. So I'm definitely trying to help the younger guys realize that you can love being a firefighter, you can have a great career, and you can do your 25, 30 years if you want, but also have something on the side that's going to give you a better life and more time and more freedom. And a lot of it too is I realized, not saying that things would have worked out with me and my son's mom, but she's from North Carolina and she always wanted to move back to North Carolina. And I was always like, I can't leave, I have this pension in place, I have my career. And if I look back on it, if I was doing real estate or had, side hustles or stuff generating income, extra income or passive income, then it gives you more flexibility. You can, if you have to relocate, or if you have maybe you're married and your spouse has a great job opportunity somewhere else, and, you don't, maybe you have a career here, but if you have other sources of income, then it gives you more flexibility for one person to move, or you guys pick up the family and move or whatnot. But it just gives you more options.
Yeah. You used the word, talking about, looking at your financial future. And if you would have gone down that path, you used the word, I think, was it risky? If you would have kept on that path. And I just think that's such an interesting way to look at it, because most of the people don't look at real estate, don't look at their financial future like that. They look at real estate investing as being risky, and working your job, pension, 401k is not being risky. But when you're dependent on somebody else, it obviously, certain things can be out of your control, especially what something happens to somebody's health, like you mentioned. Those are things that are out of your control. And so if you're not taking these other steps in a different lane, building your own future, you're missing an opportunity to be able to potentially diversify.
Yeah. Yeah. I mean, I, I see so many guys getting hurt on the job and having to take leave. and maybe their careers end up a little bit short or whatnot. But it definitely just made me reevaluate things on how risky I was. And like you're talking about, even the pension is great, but I don't really know where that money is, and I don't know
Right.
what they're investing in. And who knows? They could have invested all of that money in Bitcoin and just, everything had crashed, and now where's our pension? But that's kind of, if I look at it too, the pension keeps getting um, worse and worse, I guess you would say. So they keep having to change the pension and the retirement plan to accommodate the other guys that are, so basically the new guys are paying for the older guys that are still retired, and they keep extending it. So like for me, I can get full pension at 25 years, where the newer guys, they have to do 30 years, and there's other requirements. So as great as the pension is, and we're hearing other countries and other places, there's a lot of pension problems and pension issues, and it totally just made me start looking at things and realizing that I don't want to count on it being there. Like I think we meant, you talked about it, like Social Security. I don't know if it's going to really be there. I don't. If it is, great, but I'm not going to count on it. I'm not going to rely on it, and I want to take it into my own hands. And I'm not saying I did the smartest thing. I don't advise doing this, but I took everything out of my retirement accounts, and I put it into hard assets. I put it into real estate, and I think I made a great decision. But I said, I don't advise. You got to look at your own situation. But for me, it just made sense. Like putting it in retirement accounts. I'm like, I'm paying all these fees. I don't really know where my money is, in a sense. I have no control over it, and I have to wait so many years to really benefit from it. And a lot of the attractiveness to it is the taxes, paying less taxes when you start putting out the money. But we don't know what tax rates are going to be 20, 30 years from now, and I'd rather use that money now to build my wealth and just keep generating more income when I retire. So that's also why I'm hoping to retire from the fire department early. Trying to build this kind of brand or foundation, getting my real estate license and helping other people get started too. So it's just a vision of trying to retire early, but also have a plan in place to, if for some reason all my rentals were to burn down, I have a blueprint now on how I would build my wealth back up. Like I already have a blueprint of what I would do. House hack, definitely. I would probably house hack. But yeah, I mean,
Well, one of the things that I just think is so interesting about it, and is, anything that you learn, you learn by doing, getting out of your comfort zone. It changes the way that you look at things, changes the way you look at life, I'm sure. Um, when you've got this other vehicle that's, you can see building itself up, building a future that's, yours versus building somebody else's future, working for another company and making them money, so to speak, in certain industries. I think it's a very empowering thing personally. And then the people that I've worked with, they see, hey, I don't want to be working 60 to 62, 65 for somebody else. I want to be able to get out of the rat race. I want to be able to build something for myself. And, there's a lot of, information out there. What do you do with all that? How do you know what to do? Where do you put your energy in? And the reason I kind of go down this path and bring it up is that, I never had a mentor. I never had somebody that I could rely on that said, hey, you need to be doing this. I didn't have anybody in my world that was a real estate investor. So I didn't get it. I read some books along the way. Rich Dad Poor Dad was one of them I read a long time ago, and bought a house, my own kind of stair step method, bought a house in 2009 as a condo, lived in it for 5 years, bought another house, turned the old one into a rental. That was my first rental. And then along the way, my job was doing better and was able to purchase a couple of multifamilies and so on and so forth. But I didn't have a mentor. And so what I love about your journey is that you were able to be aware that, hey, there's somebody else out there that's already doing this. Why not learn from their mistakes? Why not learn from their the things that they've worked on and had fail, and accelerate that process? And so anybody else that's out there that's hearing this, that's this far into this message, into this podcast, that wants to learn about real estate and wants to learn about, building, financial wealth, financial freedom, don't stop. Find somebody, find a mentor, and don't stop till you find them, because there's people out there that will help you for free out of the goodness of their house, or at least point you in the right direction because they care. And there's going to be people that are going to say no or not give you the time of day, which is fine, but don't stop till you get there. And that's what I love about having Marc on the show, is that he's out there and he's willing to give his insight, willing to give his experience to the people that are out there that want to learn. So, I'm gonna stop on that little tangent. From a tax perspective, you mentioned on the 401k taxes and not knowing what the tax rates are going to be, but from a property standpoint, in terms of depreciation. So, what are your thoughts on that avenue in terms of just rentals, and then how taxes work?
So I do have an accounting degree, but I'm not a CPA. But I mean, definitely, real estate has probably some of the greatest tax benefits out there. And, a lot of people feel that the government incentivizes people to be landlords, and that's why they offer so much tax benefits. If you really look at it, right, like the government doesn't want to be in charge of housing or being in charge of or landlords. So they incentivize people to invest in real estate and be landlords. So you get a lot of tax benefits. A lot of people know about depreciation, which basically is broken over, 27 and a half years, the property value, and you deduct that off your, basically the rental income. So a lot of times you generate rental income, but on paper, for tax purposes, a lot of that income is wiped out from your depreciation, and then you have a lot of expenses that you can write off. So same thing with owning a primary residence, you can write off your mortgage interest and whatnot, and same thing for owning rentals, you can write off all these expenses. There is some other great benefits, but there's a lot of qualifications to meet, and I'm still trying to figure out how I can somehow get real estate professional status. But most people, if you have a W-2 job, it's going to be highly, highly difficult to qualify as a real estate professional status. But that's also why some people, their spouse maybe is a stay-at-home mom or dad, and they somehow transition that person into a real estate professional. And that's how they take a lot of benefits from, like cost seg studies, bonus depreciation. And even though that's starting to phase out starting this year, but there's tons of tax benefits, and you just gotta realize that you are not, when you first get a rental, you got to realize you are a business now. You have to treat yourself like a business, and there's a lot of things that you can write off on your taxes for business purposes. I mean, don't try to write off lobster dinners all the time and whatnot, but be responsible about it. But now you have a rental, you are an investor, you're basically a business, and treat it that way. And I highly recommend it. Once you get a rental, do not do your own taxes. I mean, try to get a CPA and one who's educated in real estate, because they'll probably save you a lot of tax benefits that way.
Totally. Yeah, the cost segregation abilities out there, definitely a major threshold in terms of reducing taxes. Here and now. So it's an eye opener. That's for sure. I know in our past talks, you mentioned that you participate in a mastermind. Can you share a little bit about that experience and kind of a time period, time frame, and how it all works?
Yeah, so I joined the mastermind group. It's called Simple Passive Cash Flow. The main guy is Lane Kawoka. He's a local boy from Honolulu, Hawaii, but he was living in the mainland. He went, I want to say he went to UW, but he was in the Washington area. But he's a big real estate syndicator now. Part of it is he's a local boy, so I felt a little comfortable reaching out to him or touching base with him. But his story was very similar to maybe what my vision is going to be down the road. But he started with single family home rentals. Well, he was working a lot. He had a primary residence that he realized, like, I'm never here. I'm going to start renting it out, and that's how he became a landlord. And then he started getting into out of state investing, and then he started looking into how can he scale, and then he started getting into multifamily type stuff. So just his path of starting off kind of that traditional buy a home, pay down your mortgage, and worry about that, transitioning into rentals kind of got my attention. But it it definitely, I'm a big proponent of being the dumbest person in the room, and I highly recommend anyone to join masterminds or just network, be around people that are in the business. And that's one thing that I've really found out is that just in this real estate industry, and there's just so much people willing to share knowledge and share information, and everyone is super helpful. And a lot of that is just it's all about networking, and it's all about funneling deals. I mean, that's what everybody's trying. You can't have every deal out there. So that's all it is. You're meeting people. Hey, I have this deal. I have this deal, and you're presenting to someone else, and it may not be somewhere you live, and you may, hey, I found this deal in Florida or something. But I highly recommend being around people that are in this business, and it's super helpful. But the mastermind just opened up my eyes to realizing that there's so much ways to get to financial freedom. Not everyone is as big into real estate. Most everyone has something in real estate that they're doing, but there's guys that are heavy into crypto. There's guys that are heavy into like land trusts and different things, different avenues, or business. They have their own business, but the one thing is they're all kind of leading towards the same path on how they can retire early, be generating income by when they're sleeping, basically. And it just really opens up my eyes to that there's many ways to do things, and they've all made mistakes, and that's the thing. It's wonderful to hear their experiences because you learn from that because they made mistakes, and then they're sharing it. And that's one thing is super, and that's what I want to do. I want to share people all the mistakes I made, and I know I've made tons of mistakes, and that's the one thing you have to realize is things are going to happen, bad things are going to happen, but like they say, the one thing about real estate is it's not timing the market, right? It's time in the market that's going to build your wealth. And but the mastermind is amazing. We actually have a retreat coming up in Hawaii next weekend, but it's just great being around people that are the same like-mindedness, that have the same path. And like I said, being the fire department's great, it's wonderful, but a lot of guys, they're just in this tunnel vision of working their 25 years for their pension, and going to these mastermind meetups. We usually have calls once a week, and I'll say it, I'm not the best being on the call. The calls is kind of tough. The time is That's usually when I'm picking up my son or whatnot, so it's hard to always get on the calls. But they're all recorded. You can go back, listen to them. We have Discord channels. So if anybody has like questions or something they're working on, and they'll put it in a Discord channel, and then there's people giving their feedback or their experiences. But yeah, it's super, super helpful to be around these people that are just kind of have that same vision and same path as you.
Yeah. I mean, what do they say? Your net worth is, the average of the five people around you. And, that's what I love about this type of thing is that, if you're not getting what you want, if your goal is outside of the circle that's already around you with your natural, set of friends or family, whatever, that's okay. You can go find the people out there that have the same goals. And, there's meetup groups, there's, investment groups, there's all kinds of ways to be able to find people. And social media, I mean, I'm in my late 30s and I've been living under a rock for 2 decades with work and all that stuff with my job. And this is something I've been working on personally for not even maybe 7-8 months. And I just can't believe how many people on Twitter, on Instagram that have been helpful and passing on messages and et cetera, et cetera. And so like for your journey, right, for your social media journey, I mean, you've got a decent following. What point did you start really focusing on that?
Man, I probably only really started once I got my real estate license. So maybe middle to late in 2022. And I like you said, you're late 30. I'm in my mid 40s already. And I social media just wasn't my, I mean, I would go on it just to look at it, but I wasn't like posting things and but I'm actually having fun doing it. It's kind of fun posting stuff, and it definitely is time consuming. But the one thing is just trying to. So I'm on Instagram, Facebook, Twitter. Trying to start the TikTok. I haven't figured that one out yet. But the hardest thing I realize is, you anybody that wants to start or do it, just post it, put it out there. It's never going to be perfect. And from, I don't know why, but it's impossible to get them to fit on each platform. Like, I don't know why they have to make it where it fits on this platform, it doesn't fit on that one. And you know what? Just put it out there and send it, and it'll get better. But it's fun. It is challenging, and yeah, I never thought I'd be doing this. But it's like you said. I mean, there's just people that reach out to you, and I'm meeting so much awesome people out there, and it's super fun.
Yeah, and that's the thing that I had to get over for myself. It's like, you know, I just decided I was going to post every single day and never miss a day, just for many reasons. But I was like, you know what? No one's going to look at this for months. Jeez, I'm losing my voice here. I apologize. No one's going to be looking at this for months. Like, it doesn't matter how shitty my content is. Shitty content is better than no content. That's my
Yeah.
motto that I tell people, my people. So, I mean, by the
No,
time, yeah, sorry.
no, yeah, I agree. It's just you got to put it out there. I mean, my YouTube channel. I mean, I hope nobody watches the first few, but I mean, like I think I read somewhere your first 30 to 50 videos are going to be probably bad and have no viewers, but you got to get to that 50 videos to actually start putting some momentum. So just put it out there.
Yeah, and it is definitely time consuming, but like, what's the light at the end of the tunnel? It's probably going to be different for many people out there. But at the end of the day, social media, your social profile, your digital profile, if you want to excel today, tomorrow, 5 years from now, there's going to be so many more industries that are going to be reliant on your digital profile, and it's almost going to be the new currency. I mean, it's people's attention is paying the bills. The normal media outlets are losing that control, losing that power, and it's turning into the solopreneurs out there, people like you and I that are building businesses, selling products, selling online courses, selling branding stuff. Like, it's really interesting how this is really. I put this on social media this week. This is kind of the golden age of the solopreneur. I mean, coming out of COVID, so many people were reliant on themselves to get by and doing different things to be able to make money and creative ways to be able to build businesses. And there's so many people that are doing their regular job, then also doing something on the side. And there's just so much information out there, so many creators out there just giving you the roadmap. Maybe you got to pay some money to be able to get a copy of it through an online course, a couple $100 here, whatever. But it's just so many roadmaps out there. And I've been looking at my own stuff, online course, ebook that I'm working on, amongst other things. So there's just plentiful resources out there if you want to be able to build something for yourself.
Yeah.
We're getting up on the hour here. We've got about 10 minutes or so. I kind of want to dig into the people around you. People, you mentioned some of the younger people in the squad or whatnot in terms of passing on advice. What type of advice would you give to that person that just, what, I'm ready to start learning, or I'm ready to jump out? What type of advice would you give to that person?
I think the biggest thing I would tell them is to really look at their expenses. That's probably the number one thing. And I think a lot of it is Hawaii. We get caught up, like I said, I think we mentioned earlier that the single family home is about $1 million roughly. So for a lot of guys, their frustrated and just they don't see that in their future. Like, how am I ever going to save up for a down payment on a home? And even though they do start saving, it's always growing appreciation, and they're always chasing that down payment amount. So during that process, they either go buy a Tacoma truck or they go buy a boat, and they just kind of get off the path of what they were shooting for. So I definitely feel like getting their finances in order, getting their expenses under control, and make out a plan. And there is options out there. You can do FHA loans, or house hacking is super beneficial. If you can find a property or even a place with enough rooms where you can rent out rooms and basically lower your living expense. And that's the one thing I talk to a lot of the guys is they really got to talk to their spouse too, if you have a spouse, on is house hacking an option for them? Like, it can sound like the greatest idea, but if the spouse is not on board, that's off the table. But I totally recommend, hey, that's something you got to sit down and have that conversation. Like, is that something? And I tell you, if you don't have a family, you don't have a spouse, like that is something that you want to do if you can. Like right now, look for something, do it before you have kids, do it before you're married, and just start that process and lower your living expenses. And just got to start thinking about the future. I mean, that's all it really is. And for me, my biggest thing too is I don't want to be a burden on my son as I get older. And so these younger guys, I try to tell them, when you get older, you don't want to put all this burden on your sibling, or your children, and having them to worry about taking care of you. And that's why I kind of really focused on building up my wealth, and also trying to educate my son. Yeah, he's young, but trying to teach him, like, you don't always have to buy the biggest Lego set. Don't have to spend all your money at one time, but just help him learn about finances, but also build my wealth so that when I get old, he doesn't have to really worry about me.
Well, to add on to that, if you didn't decide to purchase that first property in Pittsburgh, could you ever see yourself, if that wouldn't have happened, how would you have been able to teach him about real estate? That they may never ever happen, right?
It would have been probably, buy a home and focus on paying it down as quick as possible. Just focus on paying off your mortgage, and then nothing's wrong with that. There's definitely some benefits to having a paid off home. It does provide some security, but it also probably hinders your chances of building a certain amount of wealth too. So definitely, if I didn't find my path, he definitely would have been on the path to paying down his mortgage as quick as possible. And I hate to say it, but I definitely was on cruise control. I probably squandered a lot of opportunities, and I'm playing catch up right now. And I'm just hoping that he sees the light, or real estate, it's not for everyone. I get it, but hopefully he finds the same benefits and passion in it. And you don't have to have a huge portfolio to benefit from real estate. You could have a few rental properties, and that could change your whole trajectory. I mean, that could put you in a better financial situation. And so that's, you don't have to love real estate. And that actually, some of the guys that I've helped that bought properties out of state, that's their mindset. They're not trying to build this huge portfolio. They just want to get a few to generate extra income, but also at the same time have extra things or extra assets to leave for their children. And so, a lot of times I'm always pushing them to network and make more contacts. And you're like, oh man, I'm not trying to get 30 rental properties or what. And they're comfortable with what they have. But that's all it is. You don't have to go all in to get the benefits. But I definitely see real estate as like the path for me, and I think it's probably the best asset class out there.
Yeah, I mean, I couldn't agree more. And I just think what's so cool is that it doesn't matter where you are in your journey, right? I mean, I've talked to a couple clients that were in their 60s, that sold a couple properties, and you know, they then diverged and bought stuff in different states. Like it doesn't matter where you are. There's nothing stops you from taking the next step and starting. So I guess for 2023, any goals? What are some of the goals or visions you see for this year?
So for me, I'm a little bit more focused on the my license side right now because it's new, and I'm trying to build my brand for that. And I'm not sure if I'm going about it the right way. Like you're talking about social media earlier and whatnot. I'm definitely leaning towards building my brand and social media influence that way. I get the whole cold calling and making your calls, and I still do that, but I don't focus on it as much as, let's say, maybe other agents, and then that's their primary thing. Because I guess I don't know. Like I said, maybe I'm not doing it, but for me, the way I look at it is I don't answer my phone when people call me half the time. And so for me, I can reach more people by putting content on social media and getting more better response that way. So that's kind of what I'm focusing on now, more on the license side, while the market is also shifting and it's a little bit slower. It's easier for me to get in there and build my brand. But definitely, I'm hoping to get probably at least two more properties out of state. And the syndication, we didn't talk about that too much, but the syndication that I did with the mastermind, I'm not sure when that exit strategy is going to be, especially where the interest rates have gone. The market has shifted, so the property may be held a little bit longer. But that's always something when it does close, what to do with that, with those funds.
What
And
what type of property was acquired in that group?
so that one is it was an apartment complex in Phoenix, Arizona. So it's a value add. So that's the difference with single family homes and multifamily. Usually, the value is single family homes is based on the comps around you. So you can't really do too much to really increase the value of your property too much. Whereas multifamily or apartments is more rent based. So you can do a lot of value add if the rents are below market rent. So the syndication, I want to say I put in 2021, and so we're looking at close to 2 years now. But it's the one thing I'll say about syndications is it's if you want something super passive, like that is the way to go. So it's actually really good for high net worth individuals who are doctors, lawyers that are super busy that just don't have the time possibly to be looking into rental markets or single family homes. So the syndication is super passive, and to me, that's part of the drawback in a sense. I guess is honestly, I wouldn't have learned as much if I only did syndications. And so syndications, I definitely see as where it's more of the end game, where you've built up this wealth and you kind of just want to be very hands off already, just receive your quarterly dividend, your quarterly paychecks. And so syndications are super good on the end game side. But as far as learning the process and the single family home route, I see so much benefits in starting with that, and it just helps you be more educated when you get towards the syndication because you know certain things you're looking for in the property and whatnot.
Love it, love it. So YouTube financial firefighter, same thing on Instagram. One thing I didn't ask you, and I hate to do this late in the game here, but which island are you on for the listeners, and what are some of the types of food that you love?
I'm on Oahu, so I'm on where Waikiki is, that island. For me, sushi, poke, Hawaiian food, a lot of local dishes. We have like, shoyu chicken, kalua pork, but a lot of simple, I guess you would maybe call street food in a way, just real basic stuff. But definitely sushi and poke. And if you're not sure what poke is, it's basically just raw fish. They season it different ways. A lot of times they'll have it with rice. But those are probably the main things I try to eat.
Yeah, because aren't there some food trucks that do have in certain spots a lot of different types of food with the food trucks,
Oh yeah, we have. I mean, there's
the food
tons of different.
carts.
Yeah, there's a lot of food trucks too now, and especially on the North Shore side, they have all the famous the shrimp trucks and whatnot. So yeah, there's a lot of diversity here, and that's what Hawaii is considered like the melting pot. There's a lot of different ethnicities out here, and just different cultures came together. So there's a lot of variety of food with a little local flair or twist to a lot of the dishes out here too. So it's a cool place. I'm born and raised here, so I'm a little biased, but it is definitely a great place to visit. It's an expensive. It's the cost of living is high, housing is high. I don't know what gas is where you're at right now, but ours is still in the fives.
Yeah,
Uh,
I'm in the Midwest, so we're under 3 right now, I do believe.
yeah, I heard gas is going down, but it hasn't reached this yet. So we're kind of always behind. But I think that's kind of a trap too. A lot of people come here on vacation and they fall in love and they decide to move out here, and then they find out that everyday living is not like when you're on vacation, you know. But
So I'm gonna butcher some of these names because I'm blanking, but my wife and I we went to out to Oahu, stayed at the North Turtle Bay,
yeah, Turtle Bay, yeah.
up there. And in the mortgage industry, I have a client that happened to be retired there. So he was in the military for 20 something years and retired there on the Big Island. And so he came over and met us at the Pearl Harbor Memorial and took us to the vacant volcano. I forget the name of it. Actually,
Oh yeah, yeah.
this is it right here. No, 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 Nuana Poly Lookout. Can you see
Bali
it?
Luka, yeah.
Oh,
Yes.
it's backwards.
Oh,
Shoot.
cool.
But yeah, I mean, like at the end of the day, it is a melting pot. People coming from different places in the world, and being able to spend time with him. His name's Tom Hunts out there, longtime friend. Hello, Tom. But just the thing that comes to mind when we're talking about real estate is the relationships, right? Like you got a
Yes.
syndication that's buying stuff in Arizona. You got your firefighter friends that are maybe starting their journey, and your friend that's buying stuff in Pittsburgh. And then you mentioned before their crew that's on the ground in Pittsburgh, and just being able to develop relationships 1,000 miles away is easier and than ever before. And it's just really interesting to be able to share ideas and share connections like that. And so, um, any other thoughts for our listeners today?
No, I mean, I guess just get started. I mean, that's the number one thing. And I always anybody I'm talking to, I try to tell them the way I look at it is it's almost like when I had my son. It's you read. I read all the baby books and parenting books out there, and I read all these things. But once my son came, all those books were out the window, and it was just survival mode. And you just figure it out as you go. And I totally look at investing in real estate just like that. You can read all the books you want, you can get all the information you want, but until you actually do it or get that first property, I mean, there's so much learning by doing, and we all make mistakes. We're all still learning, and I guess the one big thing is don't compare your year one to someone else's year 10. I mean, I think that's something that frustrates a lot of people. They just, they see someone with maybe 10 properties and you have 10 properties, but that person is making 3 times as much money as you. And you're like, how come they have 10 properties? But, they might have bought it 20 years ago and you just bought yours. And that's the difference, right? The time in the market is definitely the big factor in how much wealth you're going to generate. So just get started.
Get started. I love it. I love it. So again, you can find Marc on Instagram and YouTube and amongst other places. And we're going to have you back on later in the year, check in on some progress with you. But thank you so much for making time for us today, and looking forward to following your journey as well.
Oh, thank you. This is awesome.